The market seems to have stagnated a bit, but it hasn't prevented a litany of high-quality businesses from reaching 52-week lows. But just because they have reached these lows, does that mean they are a good buy? Remember, a business can hit a 52-week low and still be well overvalued. A business can also be at the beginning of their overall downswing to even lower lows. Welcome to The Quality Investor. Today, I want to discuss 5 businesses at or near their 52-week lows that offer some good value for investors. These are businesses that usually don't dip too often, so it might be a good time to pick up some shares before they inevitably climb back up and recoup their premiums. I'll go over their fundamentals and what I believe a good entry price is. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. Before getting into the list, I want to caution everyone that 52-week lows are best used as a guide or starting point into researching a particular stock. Many times before, a stock has hit a 52-week low only to have another massive drop in share price. A good example of this is Walgreens. Once a vaunted Dow Jones Industrial member, the business has been on a decline for the last 10 years, hitting new lows seemingly every year. That is why it is important to understand the fundamentals of the business, what the future strategy is, and what type of growth drivers the business can expect to continue revenue growth. And on that point, stay tuned later this week as I will discuss 5 businesses that are at or near 52-week lows that you should avoid. But this video is on the optimistic side. So without further ado, here are 5 businesses at 52-week lows that offer some solid upside potential. This is the list that we're going to go over today. We have Microsoft, Google, Caterpillar, Applied Materials, and Chipotle. And you can see here that Microsoft, for example, is at $381.81 as of this recording. Its 52-week low is at $367.24. So you can see Microsoft is quite close to that 52-week low. Alphabet at $156.87, its 52-week low at $147.22. Caterpillar, 52-week low of $307.05, with the share price currently at $333.48. Applied Materials is sitting at $146.77, and their 52-week low is at $141.16. And Chipotle is at $51.81 with their 52-week low at $47.55. So why are these businesses good to buy on the dip? Well, historically, each of them tends to trade at a high premium, meaning they're always going to be above what we think is their real intrinsic value. And the reason for that is because they're very solid businesses. Applied Materials may be an exception to that as they're very volatile to the semiconductor market as a whole. But in my mind, there's no question that Applied Materials is on a dip that's really worth looking at. And generally speaking, they're cheap right now. Microsoft, for example, has a PE ratio of 30.7. That's slightly below its 10-year average, which is at 30.8. But it's quite below their 1-year and 3-year averages. I'll show you those ratios in a minute. Another aspect is these businesses are all fundamentally sound. Let me demonstrate that. If we look at the 5-year compound annual growth rates for what I believe are the most fundamental metrics, we can see all of them have very strong growth. Each of them have revenue growth over 10% with the exception of Caterpillar, but Caterpillar grows in other ways. The median revenue for these 5 is at 14.26 annual growth. Each of them have expanded their margins over the last 5 years. The median margin expansion being at 1.66%. And the median for the operating margin growth here is at 5.5%. And this is on an annual basis, meaning the margin itself has grown at 1.7% or 5.5% per year over the last 5 years. Not that it added 5% or 1% to the total. Earnings per share growth. Very strong earnings per share growth for each of these businesses. A median at 24.7, and this is actually where Caterpillar tends to shine. They're very good at growing their earnings per share, as well as their free cash flow per share. But all of them have very solid earnings per share growth, and then free cash flow growth. Each of them have expanded on their free cash flow growth and have grown on a median basis at 21.4%. And again, free cash flow margin. Each of them are expanding their free cash flow margins, a median here of 7.5% per year. And each of these businesses have been buying back shares, some at a faster rate than others, but that does aid in per share growth, which is of course what the investor gets to take home at the end of the day. Before we get to the buy targets for each of these businesses, I do want to quickly go over some of these profitability metrics, and in particular, return on invested capital. For Microsoft, we can see they have a trailing 12 return on invested capital at 27.8% and an ROCE, or return on capital employed, at 30%. And you can see that's grown over time. That trends up over the last 10 years. Same with gross margin and operating margin. Both of these profitability metrics have trended up over time. Microsoft sitting at nearly a 70% gross margin and at a 45% operating margin. Looking at Google, we can see they have an incredible ROIC, 31.4% ROIC and a 34.7% ROCE. The gross margin has declined a bit over the last 10 years, but it is now trending back upwards, and this is because GCP, or Google Cloud Platform, is now becoming profitable and will be an excellent growth catalyst for Google for years to come. And we're going to see that also reflected in the operating margin, now sitting at 32.11%. But this has trended up over time. Now let's look at Caterpillar. Caterpillar hasn't had the top line growth of these other businesses, but they have excellent ROIC, signaling strong decision making by management. ROIC at 21.5%, ROCE at 21.7%. But they've also expanded their margins. At the end of the day, what we're looking for is value creation. Value creation isn't just revenue growth, it's margin expansion and increasing ROIC. And Caterpillar does that, and that's why they do have strong growth in their share price over time. They have a gross margin of 36% and an operating margin of 20.2%, both of which have been trending upwards over time. They're also expanding their free cash flow margin quite dramatically here, now sitting at 13.6%. Looking at Applied Materials now, their ROIC has dipped a bit in the last couple of years, but it's still at nearly 30% for ROIC and 28.4% for ROCE. They have been investing heavily in future semiconductor equipment manufacturing, and I have no doubt that management knows what they're doing, and we'll see this trend back up here over the next few quarters and years. Margin expansion, on the other hand, has trended upwards. We're now sitting at a gross margin of 47.7% and an operating margin of 29.2%. And finally, we have Chipotle. Chipotle has an ROIC of 20.2% and an ROCE of 26.2%, both of which have trended upwards since it dipped during the COVID years. And there's also a minor dip in fiscal year 2016. This was due to a food quality scandal that broke out for Chipotle, but they have recovered quite nicely. You can see since then, their gross margin has recovered. It's now sitting at 26.7%, and their operating margin likewise recovered and is sitting at 17.55%. So what would be a good entry price for each of these businesses? So Microsoft first. Share price at $383.77 at this recording. And you can see my bear, base, and bull valuation methods here. The valuation average for the bear is $363.52, $427 for the base, and $511.91 for the bull case. And you can see there's quite a bit of upside on the base and the bull case. My entry price is right around $390. I think if it dips below that, it is a good time to start buying some Microsoft. This assumes a 10% margin of safety, and you can see here that their PE ratio is below their 5 and 10 year average. Right now, Google is at $157.58. Their PE ratio at 19.6 is well below their 5 and 10 year average, and I think there's a lot of upside for Google at this point. The market certainly does not like Google right now, and my valuation averages has the bear at $207.66, $255.50 for the base, and $325.04 for the bull case. And you can see that's quite a bit of upside. And once it comes down below 210, that's when I want to start buying Google. And that assumes a 20% margin of safety. But even with a 30% margin of safety, Google is still a very good value at $182.65. And if it dips even lower, going back down to what a 52-week low was of $147.22, we can see that has a 40% margin of safety. Google is just begging to be scooped up right now. Next, we are looking at Caterpillar. Caterpillar has a share price of $333.46. The bear valuation average at $311.11, $377.34 on the base, and $484.91 on the bull case. If Caterpillar definitely meets or exceeds their expectations for the future, there is quite a bit of upside there, especially in the bull at 45.4%. I would like a 20% margin of safety for Caterpillar, which puts their buy price at about $310.14. However, with a 15% margin of safety, depends on your comfort level, their risk, and their future. A buy price, once it comes back down under $330, wouldn't be out of the realm. They are historically cheap, however. 15.1 PE ratio right now compared to their 5-year average of 20.2 and well below their 10-year average of 26.8. The market really does not like Applied Materials at the moment. Their share price is at $148.46. My valuation average on the bear is at $194.24, $222.18 on the base, and at $259.02 on the bull case. There's quite a bit of upside on each of these scenarios, and with a 20% margin of safety, that means I want to see their price come down to below 180, which is far below that right now. In fact, it is sitting at about a 35% margin of safety. Historically, it's actually right in line with their 5 and 10-year average for the PE. However, I believe there's a lot more upside to Applied Materials in the future growth due to their current position within the semiconductor equipment industry and the absolute demand skyrocketing for highly advanced chips, which is the type of equipment Applied Materials makes to make those chips. I did an overview of Applied Materials' latest earnings a few weeks ago. Please check out that video for a more in-depth explanation of what I believe is Applied Materials upside. And finally, Chipotle. Chipotle is now sitting at $52.07. They have risen a little bit since I did this calculation. However, historically, they're quite cheap. 46.9, definitely high for a restaurant in a cyclical industry, but it's well below their 5 and 10-year averages, their 5-year average being at 67.2 and their 10-year average being at 92.7. Without any margin of safety, there is some upside there. Buy price of $55.22, and if Chipotle nails the higher end of their expansion plans, there is quite a bit of upside on the bull case. To achieve that, they do need to grow at about 350 stores per year, as well as growing their sales by about 6%. That can be achievable if Chipotle wisely uses the pricing power they do have in the market. That said, with a 10% margin of safety, they have a buy price of $49.70. And if they come back down to their 52-week low, they'd be at about a 15% margin of safety. I think if Chipotle comes back down under $50, it'd be worth it to scoop up some more shares. So that is my list of 5 high-quality businesses at or near their 52-week lows that might be worth buying on this dip. Again, it is Google, Chipotle, Microsoft, Applied Materials, and Caterpillar. Remember to stay tuned later in this week when I do 5 businesses at or near their 52-week lows to completely avoid, because I believe they're going to be going even lower. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.